Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome to Bazaar Morning Call. As always, we're coming to you from the CNBC-TV18 Motilal Oswal studios. It's a very interesting morning as we're getting into the second half of the week. There is a legal challenge to the great Trump tariff juggernaut. We have plenty to talk about, lots of local cues as well. I'm Surbhi Upadhyay. With me as always is Nigel D'Souza, and today we have Rima in the house joining in. Hi guys, morning.
Hi, good morning. It's been a historical roller coaster ride, right, with Trump headlines. Sometimes tariffs are on, sometimes they're off. But as you said, this time, it's coming in from the court.
Yeah.
Well, that's right. And from the time Trump took over, we were getting used to MAGA, right? Make America great again. But now we have a new one, TACO, right?
What's this? What's TACO?
Trump, again, chickened out.
Always chicken.
Always chicken.
Always chicken.
Wow. This is a new one.
And I'll tell you another one. I was just looking at some feed overnight, and every time the press has asked him, when are we going to hear about this finally? A month ago, he said 2 weeks. 10 days ago, he said 2 weeks. And yesterday, he said 2 weeks again. So 2 weeks, or is it 2 week? So let's see.
There was another acronym. I don't know if you knew. ABUSA?
Yeah.
Oh God, you guys are really on fire with the acronyms today. Now, what is ABUSA?
That is anywhere but USA.
Anywhere but USA.
But today's one is TACO.
TACO.
Today's, the acronym for the day is TACO.
You'd say you'd counter that by saying that he's not actually chickening out. They've gone to the higher court, and this is going all the way to the Supreme Court. So actually, on that, let's
Federal court.
Let's get to it. So what we have is plenty of excitement post the U.S. market close. The market close was actually negative. U.S. indices were down about 0.5%. The Dow, the S&P 500 and the Nasdaq, they all ended with cuts of about 0.5%. But then this news came in. So the U.S. Court of International Trade has struck down Trump's reciprocal tariffs. There were, 5 to 6 people who had gone to the court, businesses, U.S. businesses, challenging the reciprocal tariff order, saying that it is constitutionally not valid, and the court ruled in their favor. So the court, in fact, has said that the reciprocal tariff order needs to be vacated. And the court says that the International Emergency Economic Powers Act, remember, it was this particular piece of legislation under which Trump, initiated these reciprocal tariffs on the 2nd of April. The court said that this particular act does not give him unilateral powers to pass a law like this. It needs to go through Congress. So therefore, the court struck this down. But the U.S. administration, as expected, they were very quick on the response. They've already gone and appealed this in the Court of Appeals at the federal circuit level. The sense is that this is not ending. I mean, these are the lower courts in the U.S. Eventually, this might go all the way to the U.S. Supreme Court. Let's see, the legal challenge is on. In the interim, the market first reaction, as you would expect, is that of, relief. And that's what we're seeing across asset classes, starting with U.S. equities. So if you look at Wall Street futures, Nasdaq, Dow, S&P 500, they're up anywhere between 1% to 2%. Nasdaq, of course, being the most jubilant at this point in time. And this is also playing out across, the dollar index as well as yields. Actually, let's pull up the dollar index while we're speaking about it. Last I checked, the DXY had rallied about 0.5%, and it's once again back above the 100 handle. So watch out for this. On the yields front, the US 10-year is still at around 4.5%. So we don't have a massive reaction in the bond market just yet. Let's see. We'll see how this plays out as the US market opens and digests this piece of news. As I said, this is also not certain. The legal challenge is by no means done. This is going probably to higher court. So we'll see how this plays out. The other piece of news that the market was reacting very well to, especially in after hours, was NVIDIA's numbers. And NVIDIA's numbers, despite the fact that they're almost completely restricted from selling their chips to China, the numbers are better. The top line growth was 69%, which is more than what the estimates were. And of course, the company acknowledged the fact that they've had to take a $4.5 billion charge because they've been restrained from selling those chips because of security concerns to a big market like China. In fact, NVIDIA CEO Jensen Huang said that the $50 billion Chinese market for AI chips is effectively closed for US industry. He was very vocal in that analyst call in calling this out. But he then also went on to say that there is a very strong demand for their Blackwell chips, the other chips in the rest of the world. And that's where the beat kind of came in from. Nvidia shares in after hours are up almost 5-6%. So let's watch for this. So this coupled with that court order is getting the markets very, very excited. Some of that is playing out across Asia. Rima will talk about that in more detail in just a bit. Now, for us here, the issue is that the market at an index level is getting very, very narrow and range-bound. And we saw that on the index, Nifty, Bank Nifty, very, very range. The action is all in the mid-caps and the small caps. And we're seeing outsized earnings reactions wherever earnings are positive. Today, we have some interesting names like Bata. Bata is still weak. Cummins, well, estimates were weak. It's better than those weak estimates. So let's see how this goes. So watch out for specific stock reactions. Speaking of specific stocks, IndusInd Bank. Now, once again, the bad news just doesn't seem to be ending. Yesterday, the market regulator has come out with a scathing order. It has banned not just the ex-CEO Sumant Katpalia, but 4 others, key management personnel, from accessing the securities market on charges of violation of insider trading rules. What is SEBI saying? SEBI saying, remember, this was on the 10th of April when the announcements were made about the discrepancy in the derivative portfolio. And it seems that there was some selling of shares before that announcement was made to the public. So the allegation is, or the assessment of the regulator is, that these key management personnel acted on unpublished price-sensitive information and prevented, themselves from huge losses. So the notice has gone out. Not just that, SEBI is looking to impound close to 20 crores from these 5 personnel. So let's watch for this. We'll talk more about this from the experts as well. Need to see if this has an overall impact. IndusInd Bank, whether it's limited to that or whether there's a spillover impact, we'll see. Usually it's been ring-fenced around one stock and not the entire Bank Nifty. So we'll watch for this. Rima?
Well, back to the Asian markets, Asian markets are on the move. So this latest headline on the tariff block seems to have triggered buying across the Asian markets. Kospi is leading the gains, 1.7% up. Nikkei is up 1.6%. You've got the Taiwanese markets also higher, as you can see, by close to about 0.6%. Hang Seng muted gains, but gains nonetheless. But as we said, the bigger moves are in Kospi and Nikkei, where gains are about 1.5 to 2%. The big cues in Dalal Street today, one are the flows numbers. But remember, yesterday we had that very large BAT stake sale in IT sales. So numbers are skewed on account of that. But yesterday we had the DIs buying 7,900 crores, while the FIs net bought 4,662 crore. So that's a positive, but India's macro is flashing some caution. So just want to put on board the April industrial IIP growth. That's the IIP growth for the month of April. It slowed to 2.7% versus 3.9% in March, and it's sharply below last year's figure of 5.2%. Also, gold prices, by the way, have declined slightly. And oil prices have climbed on account of supply concerns. But Nigel, today is the Nifty monthly expiry, and so far we've been ranged. It's been 24,500 on the way down to 25,000, 25,100 on the way up. What will expiry throw up for us?
That's right. That should be the broad range, 24,650 on the downside and 25,050 odd on the upside. Now, if you're looking at the rollovers getting into expiry day, the Nifty rollovers actually are a little bit higher than what we have seen in the past series. So at around 70%, previous series it was at around 65%. Though the Nifty Bank, that's more or less in line. For the market on the whole, the rollovers are fairly in line with what we see getting into an expiry day. So that's about the rollover picture. Well, moving to what the FIs did, well, they added shorts. They added shorts both on index futures. They added close to 9,000 shorts, while even on stock futures, they added close to around 30,000 short contracts, while they unwound some longs. This could be, though, some kind of arbitrage that's taking place, getting into expiry day. A bigger trend, though, will emerge from tomorrow. But I like a market with some shorts in the system, and that's been the trend for the last many, many months. So if you look at the FI positioning, from around 30,000 short contracts, well, that number has moved all the way to around 80,000 short contracts. Shorts in the system is not such a bad thing, and FI shorts was something that actually this market was missing. But will require some good news to actually make them squeeze the shorts out. Clients on the flip side, well, they are on the opposite end of the spectrum. Clients, that's the domestic big players, they have net long positions on the market to the tune of close to around 70,000 contracts or thereabouts. But today, since it's expiry day, we'll have to keep an eye on the options data. And that's going to be very, very important. And the PCR, last week it hit a high of around 1.2. That's cooled off to around 0.7. It's at the lower end of the band because the call writers, they believe they've got this covered just for today at least, till the end of the series. That's why you're seeing aggressive writing at around the 24,800 call, 24,750 call. Extremely active in yesterday's trading session. But there is some writing being seen at the 24,750. So just plugging the numbers, looking at the options data, well, you'll get the levels that come up for you on the screen. On the upside, 25,080, that's been a bit of a resistance mark. We visited that mark, in fact, earlier this week, and it got rejected. So this is the resistance zone that you're looking at. You know, if the Nifty can actually trade above the 25,000 mark for some part of the trading session, getting into the expiry hour, then anything can work out there. But on the downside, you don't want to see this level getting broken out. 25,000, 24,600, 24,650. It has the 20 DMA as well out there. But since it appears the tariffs could take a bit of a backseat just in the near term, and we also have NVIDIA's numbers that actually have been taken positively, I'll keep an eye out on two global-facing sectors. The metal index as well as the tech index, both of them will be in focus. The metal index will be interesting because the dollar index actually has strengthened a little bit. And from the metals pack itself, you had Nalco yesterday that ended at the high point of the day. In Guinea, we are seeing some of those bauxite mines where the leases are getting cancelled out. That's what could keep alumina prices elevated. So that's why I'll keep an eye out on Nalco. Very, very strong close is what we had yesterday. Maybe the alumina prices get some kind of support, which is good for Nalco. So that one's on my radar.
Okay, we'll watch out for Nalco for sure. Nigel, thanks for that. Let's take it away then with our first set of guests. We have with us Ed Yardini, President at Yardini Research, as well as Arvind Subramanian, Managing Partner, Geosphere Capital Management, to make sense of now what seems to be a bit of a legal challenge that has started. Gentlemen, thanks very much for joining in. Mr. Yardini, let me come to you. You've been actually very positive otherwise fundamentally on US equities. How do you see this, legal issue now playing out? The administration has gone ahead and, appealed in the Court of Appeals. Does this, put a pause in the current negotiations at all? I mean, what happens now?
It's a very messy situation for sure. Why would any country now want to proceed with negotiating with the administration when the court just questioned whether the tariffs have any constitutional right to exist in the first place? But I think everybody knows that there's no way that you can negotiate a trade treaty in 90 days. I think we're still going to get some letters of agreement between us and our major trading partners on continuing to negotiate fair trade deals. So I think there'll be a lot of face saving going on, and I think the president is basically going to declare victory and try to put this whole thing behind him by the middle to the end of the summer. I think the president really can't afford to have this thing go on and risk causing a recession, which then would create some real problems for him in the midterm elections next year in November. So all in all, I've been anticipating that this too shall pass, that it'll be over by the summer, and it looks like it's pretty much on schedule to do that.
So you're saying that countries will keep the negotiation window open. I mean, I don't know if they have a choice. This is despite the fact that the legal challenge is there. Do you expect it to be a more prolonged, long drawn out kind of legal battle till we have a final order from, I don't know, maybe the US Supreme Court?
Yeah, I think it, I don't know the exact route that it goes to from this court. There's obviously an appeals court, but it could very quickly go up to the Supreme Court, and the Supreme Court might very well confirm that the president was out of step with claiming that there's a national emergency related to the trade deficit that required these kind of actions on the tariff side. But I think our major trading partners are going to go along with they're going to go with the flow, and I think then the discussions will continue. There will be short letters of agreement or maybe 5 pages of frameworks that the president can declare as victory, and then put this issue behind us.
Arvind, hi, morning. Night to you. This is Rima here. As Ed just said, things are going to get messy right now. Given that the Trump administration plans to appeal this decision, what are the various market scenarios one needs to prepare for?
Well, there's one other thing that Ed didn't cover, which is that what the court did not rule out or push back on is the Section 232 tariffs on steel and aluminum. And what I think will end up happening is, for the easy victories, there's a Section 232 study or whatever it's called going on by the Commerce Department on copper. There's another one on pharmaceuticals, and I think there's a third one on auto parts. What is going to end up happening is President Trump will try to, move those forward, and then try to use exemptions on those tariffs as bargaining chips. I agree with what Ed said, that people will give Trump some face-saving, quote-unquote, victory.
Oops.
Oopsie. All right. Well, we'll get Arvind back into this discussion. But let's go back to Ed. Ed, what should the approach be then to equity markets? India has done quite well. You told us in the past that S&P 500 is closer to your target. I think you had scaled it down from around 6,500 to around 6,000. Right. How would you approach this entire global equity market piece? And do you think that for the second half now, we should be satisfied with more subdued returns?
Well, while all this was going on, all this Trump tariff turmoil, as I call it, has been going on, the market also sold off on concerns that the introduction of China's DeepSeek back in January meant that companies were spending much too much money on AI infrastructure that they would never get a return on. And so I think that was another important reason why the stock market in the United States and in China and other places took a dive, because AI, the whole digital revolution, the whole idea that technology is going to create tremendous opportunities, that all got kind of threatened by DeepSeek. But then the major U.S. Companies that are involved in AI infrastructure and in the cloud, like Microsoft and Amazon and Meta and Google, they all confirmed that they intend to spend collectively $350 billion on AI infrastructure, which really means cloud infrastructure. I think we have to get over this idea that it's all AI. What it really is processing as much data as we possibly can, as quickly as we can, as cheaply as we can. And AI just is a evolution of that digital revolution. And so I think NVIDIA today, after the market closed in the United States, certainly provided some very good indicators of how strong their sales still are, how strong their earnings still are. The stock rose sharply. So I think the market's up this evening, at least in the futures market for the United States, is up because of these two developments. First, NVIDIA's better than expected. And secondly, the whole tariff situation may get messier, but it's probably on its way to being much less important.
All right, we have Arvind back with us as well. Arvind, you want to give us your comment with regard to how the entire global scenario is playing out, your preference with regard to equities, particularly India, and from India, which is the couple of themes that you like? I think power in the past, defense as well, we have briefly spoken about. But if you name one sector, which one would it be?
Well, I would say that anything domestic facing is something that we like. Obviously this removes a headwind on the global sectors, but I think that India is not as big a play on global sectors. So I would say anything domestic facing. And then I think metals is an area that I don't look at India too often, but I think there are a couple of interesting metals companies. And to the extent that global growth is back on track, I think metals is an area that is of great interest to us.
Arvind, just a question. Around you, are you really still hearing that chatter saying, let's diversify a little away from US equities, or is it kind of back to the US because the tech story is still strong, tariffs, etc.? Basically, what are you hearing on this whole point on diversification away from the US? And then where does India fit in that chatter, if at all?
Well, I would say that, yes, because of the uncertainty in the US, there has been move to diversify away from the US and reduce risk. To the extent that the courts severely constrain President Trump, it'll make the risk a little bit less in the US, but I still think that the global diversification is alive, but I don't think there'll be as much of a dumping of US assets and as much of a weakening of US dollar. But I think there's another risk. We're talking about tariffs right now, but there's the the fiscal deficit risk and the US bond yields shooting up. And if that continues to misbehave because of a widening fiscal deficit, then avoiding the U.S. and going elsewhere is something that will still come to the fore. So there's an offsetting factor here on tariffs, but the fiscal deficit issue has not gone away. On the other hand, like you correctly said, the tech sector still, the U.S. remains the envy of the world, and so India and other countries will benefit if their domestic growth is good. And right now, in India, for instance, we're seeing some mixed numbers on domestic growth. So I think that's going to be the challenge in terms of from diversifying away from the U.S. to where.
Ed, just getting back to the legal block story, can the administration reclassify the tariffs under different legislations, since the court has deemed that you can't do it under the Emergency Economic Powers Act? And also, since the court has said that, the Trump has exceeded his authority by using the IEEPA, and only the Congress has the constitutional right to regulate tariffs, will this undermine any future administrative decisions?
Well, again, I think the only logical conclusion right now is it's a messy situation. It's not clear which way the administration is going to go. Right now, it looks like it's just going to stick with its current policies and its current claim of why they have the power to declare an emergency and then use that declaration as an excuse for renegotiating tariff deals. I think they're going to pursue that right up to the Supreme Court. And I don't know that there really is much of an alternative to that. I think Arvind makes a very good point about industry-specific tariffs on steel and aluminum and pharmaceuticals, and that might be an interesting way to claim victory, that we still have those tariffs on. And as Arvind said, that they may very well be a useful way to negotiate additional trade deals with countries without using the national emergency excuse.
Sanger, I was just reading that, what next after the reciprocal tariffs were struck down by the court? If the Court of International Trade's ruling is upheld, then will all the tariffs collected by the U.S. from 2nd of April, will that have to be refunded?
From what I've read, that's what it seems to be, that they will be have to be refunded. Now, they haven't collected that much, but, it's been one of the hidden kind of economic benefits of tariffs in terms of fiscal deficit. Just, I think, in the last 24 hours, there was an article by Peter Navarro claiming that the Congressional Budget Office is not taking into account all the revenues that are going to come from tariffs that are going to help reduce the fiscal deficit. And now that argument is out the window. So, yes, I think that there is a real question about all these tens of billions that have been collected will need to be refunded. So, I think, as Ed has correctly put it, it's a messy situation. And I'm not sure how this is going to go. But, it's not some kind of, a lot of the court cases that have gone against Trump have been local jurisdictions putting national, claim. And there is a case in front of the Supreme Court claiming that these local courts shouldn't have jurisdiction to stop anything nationally. This is the International Trade Court. There is no claim that they don't have jurisdiction on trade. Now, it's not a jurisdiction question, which Trump is arguing against the Supreme Court on other cases. This is really a question of whether the court ruled incorrectly or not. And that's going to be a harder case to overturn, because these guys are specialists on international trade law. Doesn't mean it can't be overturned, but I think that it looks to me like this is going to be, again, I'm no legal expert, but it looks like, just from the logic standpoint, it seems like what they said makes complete logical sense, and it's going to be a tough one for Trump to overturn.
Okay, all right. Thanks a lot, gentlemen, for joining in, Arvind as well as Ed. Appreciate you joining in and giving us your thoughts on how do you all see markets pan out. Well, taco, though, seems to be the buzzword among the international press. But Trump remains firm and clarifies he is not chickening out on trade. Let's listen into that soundbite.
And then I chicken out. I've never heard that. You mean because I reduced China from 145% that I set down to 100 and then down to another number? And I said you have to open up your whole country. And because I I gave the European Union a 50% tax tariff, and they called up and they said, please, let's meet right now. Please, let's meet right now. And I said, okay, I'll give you till July 9. I actually asked them, I said, what's the date? Because they weren't willing to meet. And after I did what I did, they said, we'll meet anytime you want. And we have an end date of July 9th. You call that chickening out? Because we have $14 trillion now invested, committed to investing. 6 months ago, this country was stone cold dead. We had a dead country. We had a country people didn't think it was going to survive, and you ask a nasty question like that. It's called negotiation.
Okay, that's the big global story. But let's get back to Dalal Street and tell you what's lined up for you on our show today. These are the interactions. So coming up first at 8:35, we'll connect with Amit Tandon, MD of IIAS, SEBI Bar's former IndusInd CEO, 4 others from the market for insider trading. 9:20, we'll connect with our market master of the day, BofA Securities' Amish Shah and Arvind Maheshwari. They'll talk about BofA Securities' 2025 India Conference. Following that, the management of EID Parry India will be chatting with us at 9:40 to discuss their Q4 earnings. A little later, 9:50 a.m., Vishal Goyal of UBS Securities will join in from the UBS Asian Investment Conference 2025. Towards the end of the show, in our special segment, It's the Economy, Lata will be in conversation with Ashish Gupta of Axis AMC and Rikin Shah of IIFL Capital on the state of bond yields and banks in India.
Well, time to slip into a quick break, but we have a lot of stock-specific action to track for you today. We'll get to that in just a bit in our special Top 10 segment. We're looking at IRCTC, Cummins India, SAIL and Wellspun Corp. All of them will be reacting to positive news flow on the flip side. We have IndusInd Bank, Max Financial, Bata India, Cohance Life Sciences, Napco Pharma and Berlasoft. They'll be reacting to negative news flow. Slip into that break, come back, we'll get into further detail on all of these names.
Welcome back. Let's get to the top stocks you need to watch this Thursday morning. Our research team is standing by with CNBC-TV18's list of top stocks for the day. And first up, the big one will be IndusInd Bank on allegations of insider trading. Ritu joins in with more. Ritu.
Well, SEBI has barred former IndusInd Bank CEO Sumant Katpalia, former Deputy CEO Arun Khurana and 3 other top executives for alleged insider trading, which includes Anil Rao, the Chief Administrative Officer, who's currently part of the executive committee overseeing the bank in the absence of a new CEO. Now, their bank accounts have been impounded for a total of 19.78 crore rupees, 14.4 crores of which is for Khurana alone, 5.2 crores for Katpalia and smaller amounts for the others. Now, SEBI found that they sold shares during the UPSI period without any purchases, avoiding significant losses, and all 5 of them have now been banned from dealing in securities and cannot move their funds or assets without SEBI's permission until final orders. The regulator is also probing others and says this interim order is going to remain in force until the investigation is completed.
Okay, all right, Ritu, got that. That's a really important story, and we'll dive a little deeper into that in just a bit. But there's more news coming in from Max Financial, not earnings, but it seems that there could be a change in the management. Vamshi, good morning.
Well, good morning, Surmi. Well, that's right. Prashant Tripathi is expected to take an early retirement from his position as MD and CEO of Axis Max Life Insurance. Keep in mind that he has been at the helm since the last 6 years, and his retirement will come into effect from September 30th of this year. This news is largely negative, and that is because, there has been no clear succession plan that has been announced for now, and September is not very far away. We also have a note coming in from Jefferies, and they say that this development comes as a tad setback for the company. Smooth succession will be key, and an internal elevation may be preferred. However, they also add that sectoral tailwinds on regulations, some shift to non-par and healthy business growth can provide some cushion. They're expecting some correction, but they say that this could be an opportunity to add. As of now, they have a buy rating, target price of 1,700, but this development doesn't bode well for the company, therefore going with the red for this counter.
Okay, all right, Vamakshi, thanks a lot for that. Well, let's hop across to Manglam. He's here to tell us about IRCTC and Bata India. Manglam?
Well, for IRCTC, the results are pretty much on track. We have 10% revenue growth that has come by. The profitability has grown by about 26%. Margins steady at that 30% mark as well. We saw a boost coming in from other income. And their key segment, the key driver for earnings for them is the ticketing business, which saw near 9% revenue growth, 11% operating profit growth, so no problems out there. Catering business, well, the revenues were flat. There was a big jump in profitability out there, so that supported their overall business. And tourism, which saw a big surge year on year, my sense is that has been on account of Kumbh, 38% revenue growth and 161% EBIT growth on a favorable base as well. Bata, on the other hand, has been a tired set of numbers. I mean, it reminds you of a shoe that you've put in your cabinet, used to be your favorite some 5-6 years ago, but you don't get occasions to wear it anymore, but you still can't throw it. That's the kind of numbers that Bata has reported. 1% decline in revenues, about 2.5% decline in profits in EBITDA, and net profit has declined by about 27% as well. The company said volume growth has taken place this quarter, but importantly, they've gone ahead and reduced their inventory. So they are downsizing their inventory, and that's impacted their overall revenue performance. But just keep an eye out on how this performs, largely because over the last many quarters, these numbers have disappointed. There hasn't been that funk or spring in the step.
Manglam, you touched a raw nerve there. A shoe that you don't feel like throwing out and you don't feel like wearing either. I have plenty of those in my cabinet, I can tell you. That's a great analogy. Thanks very much. Go back to Vamshi then on Cummins. The expectations are always running low, but I guess, Vamshi, it's beaten at least those low expectations.
Well, Surbhi, when you look at the revenue, that has come in a tad lower as compared to what the street was expecting. The street was expecting some double-digit growth in the revenue, but this time around we're only seeing a 6% growth in the revenue, and that is because the domestic market was largely flat. It is up only 0.5% on a year-on-year basis, but what actually led the growth was the exports part of the business, because that saw a very good uptick of almost 39%. In fact, this is the second quarter wherein the company has reported a year-on-year uptick in the exports, given the kind of low base that we saw last year. But apart from that, when we look at the operational performance of the company, that has come in much better than what the street was anticipating. Keep in mind that there was a one-off in the base quarter, which sort of pushed the margins higher back then. But given that, the margins were expected to decline, but the decline in margins this time around has been not as worse as it was feared. So the margins have only declined by 235 basis points. The net profit too is taking a hit of almost 72.2%, but this is much better than what the street was expecting. Now, the management has said that they witnessed partial recovery in export demand. They're hopeful that the positive trend will continue, but they're quite cautiously optimistic as far as both the exports and domestic market is concerned. The con call is scheduled at 10, so we'll be waiting for the management commentary and the guidance for FY26. But for now, it's an operations-led beat for Cummins.
All right, got it. Vama, thanks a lot for that. Well, I'm looking at SAIL, and first look of it, actually, the numbers look very, very good, but there are a couple of adjustments you need to make. Nonetheless, even with those adjustments, the numbers actually look good. So to run you through the fine print on the top line, there's a big beat. The key reason for the beat on the top line is actually volumes, because volume growth came in at around 17%. They clocked 5.3 million tons. The sheet was closer to the vicinity of around 5 to around 5.1 million tons. So volumes are strong. But realizations actually were a little weaker than what the sheet was working with. First look of it, the EBITDA number looked very, very good, came in at around 3,400 crores. However, it included an element of the railway price increases that they normally get, which was to the tune of around 680 crores. So adjusted for that, actually, the adjusted EBITDA is mildly better. It's a beat of close to around 3 or 4% or thereabouts, not as a bigger beat as it looked like at first look. Other expenditure as well was up only around 10%, while your volumes are up by around 17%, tells you that the other expenditure on a per ton basis was actually down by close to around 5%. The kicker is that they've again reduced their debt by close to around a couple of thousand crores, close to around 3,500 crores. So release of working capital has played out as well. Going with green on this one, the stock has already seen a good rally, but these numbers deserve a thumbs up. Let's go to Ekta. Ekta's tracking a couple of pharma names. Ekta, take it away.
Well, yes, I'll start with Napco Pharma, which is in focus on the back of its numbers. So its revenue, EBITDA, margins as well as profit came in below what the street was anticipating. I'm working with two estimates, Axis as well as Nuvama. So it missed those estimates. It came in at around 1,221 crores. Axis was at around 1,431 crores. EBITDA margins 44.9% versus estimates of around even 55%, and profit of around 406 crores versus estimates of even up to 600 odd crores. Now the numbers were aided by Revlimid generic, which was expected. The formulation Q4 revenue was the the key driver because of Revlimid sales, but that seemed to have missed estimates. The call is at 11 a.m. today, more details then. But if you look at it, based on these estimates, which the street was working it with, it's a little bit of a disappointment.
Thank you very much for that. I'm looking at Berlasoft. It's the last of the mid-cap IT companies yet to report numbers. It's a mixed bag. The top line has disappointed, but margins have positively surprised. So constant currency revenue growth has declined sharply, both quarter-on-quarter and on a year-on-year basis. Revenues down 5.3% sequentially, and on a year-on-year basis, revenues are down nearly 7%. But the good part is the company has managed to expand margins by 120 basis points to 13.2%, and that drove about a 4.5% increase in the company's profitability. There's a conference call which is actually currently underway. It started at 8 o'clock, so we'll await clarity from what comes out of it.
Okay, that's Berlasoft. Let's get back to Ekta. Ekta, Cohance, how did this one fare?
Well, you know, it's a lot of one-offs this quarter because it is a CDMO API play, but it is formed by the merger of multiple companies, inclusive of Suven Pharma. So the numbers are not really comparable. So I'm just going to go with the margins, which look a little disappointing on a year-on-year as well as on a sequential basis. It came in at 18.3% versus around 29% on a year-on-year basis, and the profit was lower as well. But the outlook seems quite positive from the management, so that's probably going to negate a little bit of the margin pressure. Overall, it's a moving picture really for Cohance, considering that it's the integration of multiple companies that we're dealing with. The CDMO Q4 revenue was up around 31% on a year-on-year basis. Their outlook, even for the specialty chemicals business, is quite positive. So overall, that should probably, cushion the stock, if nothing.
Okay, all right, Ekta, thanks a lot for that. Well, I'm going to be looking at Wellspun Corp, and yesterday the stock, you need to know that it ended with solid gains of close to around 3% or thereabouts, though it's close to around 10% away from its fresh 52-week high. Well, looking at the numbers, it's good because just track the EBITDA number. That's gradually been improving, and it came in at around 460 crores. That's almost the highest quarterly run rate that the company has ever achieved. So that's good news. Now, the guidance that they lay out, well, it includes the other income. But that guidance is very, very strong because they are factoring in an EBITDA growth of close to around 18% in FY26 in comparison to what they have delivered in FY25, which is again better than what they had guided for both in FY25 as well as FY24. Now, from a net debt company, they've turned into a net cash company. They have a big capex of close to around 5,000 crores or thereabouts, but they have close to 1,000 crores of cash in their books, and they're throwing up free cash flows of roughly around operating cash flows of close to around 1,500 crores. They've also announced a new project in LSAW pipes in the United States because they're saying that demand is very, very strong. Put everything together, good visibility from here on, and good guidance going with green on Wellspun Corp.
Okay, all right. Let's quickly recap then our list of top stocks to watch. The ones that have positive news flow are IRCTC, Cummins India, SAIL and Wellspun Corp. Stocks with negative news flow, IndusInd Bank, Max Financial, Bata India, Cohance Life Sciences, Natco Pharma and Berlasoft. Okay, so that's our stock list for the morning. Let's now head across to Manisha, talk about commodities and all the headlines coming in from the US courts now. Manisha, I don't know if that's more exciting or the fact that, by the way, oil prices have risen over 1% overnight. With all these OPEC discussions. Tell us more.
Oh, well, absolutely. The major headline, of course, comes in from U.S., from the federal court, ruling out Trump overstepping authority on imposing reciprocal tariffs. That is one major reason. And yes, the OPEC and allies meeting that happened yesterday, which winded down without moving anything really. They have maintained current quota in sense of their outputs there, and that has supported the crude oil prices. So we're trading above $65 a barrel right now. It was a good gain in the New York session, and the Asian markets seem to be building up on that. Having said that, the US dollar index has climbed over 100, and that seems to be capping some gains for many of these dollar-denominated commodities. Gold and silver as one where we've seen profit taking come in for both of them in New York session as a knee-jerk reaction, but some opportunity buying really seems to be returning in the Asian markets right now. It is a lot of things. I mean, US federal court is one part of it, but if you look at the markets, it still is supply concerns coming in. Chile, the biggest copper producing country, has raised price projections for metals in this year and next as well. on easing trade war tension, supply disruptions that signal that the market is swinging into deficit, especially in case of copper. So after seeing that profit taking in the New York session, we've seen some buying happen in the Asian markets right now. So copper is trading in the positive. We've also seen silver prices gain up a bit. Aluminum has turned in the positive as well. Zinc prices gained up 1% yesterday and are trading 0.5% up right now. So for overall metals and energy, it seems like a good start.
Thank you, Manisha. For that, we will get into a break. On the other side, we'll connect with Dipan Mehta of Elixir Equities for some fundamental stock talk. Stay tuned.
Welcome back. You're tuned in to Bazaar Morning Call and hope you're having a good morning. Well, as promised, let's get in Dipan Mehta, Director at Elixir Equities, who joins us on the show. Hi, Dipan. Good morning. It seems the global markets are in a better place, going by the cues that we've got overnight. And maybe Trump's tariffs get pushed back a little bit, but there's still uncertainty. That said, earnings season has almost come to an end, and we have plenty of earnings here to track. Cummins, we have SAIL, Wellspun Corp. Anything stood out for you?
Yeah, good morning, Nigel, and thank you for having me on your show. Well, not really, I think, not from yesterday's earnings season, but there have been a few, I would say, outperformers in this earnings season as well. And they are scattered across various industries. Like, for example, cement, which you were very positive on. Large cap cement largely came in line, but smaller company like Berlasoft delivered exceptionally good set of numbers. And then within the tech space, I thought Persistent and Coforge came with good set of numbers, but the rest of the industry really disappointed. Within the NBFC space, I was particularly pleased with Bajaj Finance, but a lot of other companies disappointed. Piramal Enterprises slowly getting into recovery mode in the NBFC space. So like that, if you go sector by sector, there are certain outperforming companies within that sector. But by and large, I'm not completely pleased with the banking, quarterly season, purely on account of very, I would say, tepid set of numbers coming from the banks, which were below our expectation.
Okay. Speaking of banks, Dipan, hi, morning. IndusInd Bank, in this entire episode, rather disastrous episode, the low that it's hit is closer to 680. I mean, basically, the stock has been below 700, but it rallied from there, and now it's at 800. And more skeletons keep tumbling out. And this is just, it really shakes confidence, right? That this is not an inadvertent entry by, some member of the team. But this smacks of a deeper rot. While it's a very big story otherwise, and we'll discuss and debate it, what about the stock? Could it fall more, or do you think it's all in the price as well?
No, I think that largely it's got discounted. And it's trading at extremely attractive valuations, price to book, price to earnings. Typically, banks in the past who have got into such kind of a mess, they trade at those valuations. And I think all eyes are on the new team which takes over, and give them a year or so to kind of get the house in order. And you may see again the bank recovering lost ground. So I think by and large, investors have factored in all of these negative aspects. But the banking industry per se is doing well, and interest rate cuts and improvement in liquidity, higher credit growth will help IndusInd tide over this crisis which they are in just now. And if valuations go back to 1.2 times book, that's 30-40% type of appreciation from here. So I think investors sticking in over there just as we are. I think we are also investors of IndusInd Bank. The time to sell is gone, so you just hang in there, I guess.
Yeah, I mean, the stock is halved. I mean, from the peak was in January 24, 1.5 years back. The stock used to be a 1,600 rupee stock. Today, it's 800. So it's halved, and I think that's the point that Dipan is making. The worst is already in the price, and you're waiting to play the turnaround now.
In fact, now it's eroded all the returns over the last 3 years. In the last 3 years, the stock is down close to about 10-13%. But Dipan, is it time to buy at 800? It may not be time to sell, but at this price, would you look at averaging out? Since
now he's smiling. Now Dipan is smiling.
You're asking the wrong person.
You're saying enough exposure I have already.
Yeah,
no, but for a neutral person, Dipan, this is actually a serious question, right? I mean, there will be people out in the market who will wonder whether this is a great time. You buy a company in disaster and in crisis. But is that approach, is that a advisable approach, a fresh buy now?
See, first of all, if investors want to increase their exposure to the lenders, the better way to do it would be to the NBFCs. So I prefer Bajaj Finance, L&T Finance, Chola, companies like that. You could even look at gold loan companies. I think Muthoot came with a very good set of numbers. And a lot of other banks also expanding their gold loan portfolio. You could look at some other banks focused over there. So there are a lot of choices within the lending space. And I prefer the NBFCs because the lower interest rate clearly benefits them, and then certain changes are taking place in the risk weightages as well. And they are far more flexible when it comes to lending and growing the loan book. So that's why I would avoid IndusInd Bank at this point of time. Just playing for recovery is not a great strategy. It doesn't really work out. 1 year could be 2 years, 3 years, who knows, So I wouldn't advocate buying IndusInd at these levels.
The other financial stock, Dipan, in focus would be Max Financial. Because the CEO, Prashant Tripathi's sudden resignation would have come as a setback, would have taken people by surprise. If the stock corrects today, is it an opportunity to buy?
See, Rima, I have kind of given up on insurance. I spent years and years trying to understand the business, try and value it, see what variables make it tick, and what are the kind of factors one should look for. But look at the 10-year track record of the industry in terms of delivering returns to shareholders. That is very, very ordinary, well below the sensex nifty returns as well. And I come to the conclusion that this industry is heavily regulated, and to value it is a bit of a challenge for ordinary investors, even professional investors. So I'm kind of, getting underweight to nil weight insurance companies. When you want to play the financialization scheme, I think there are better choices, better segments within that, like the wealth managers are there, the asset managers are there. There are the stockbrokers, the exchanges. I think the better way to play financialization is through those segments than through insurance companies. So I'm just kind of, getting very, very underweight all of these stocks, Max Financial included.
Okay, all right. Dipan, request you to stay with us. We have a few more questions for you. For the time being, we take a short break. Come back, we'll get our technical experts. Sudarshan Sukhani and Mitesh Thakkar are waiting for us.
All right. Well, let's get to the technical picture. Like we've been telling you, that the picture overall is fairly okay, and Asian markets are tracking that sharp gain that's expected on Wall Street, which is why the implied open is suggesting that we'll have a 70-point pop at the start, getting once again back to the closer to the 25,000 mark, perhaps. Sudarshan Sukhani and Mitesh Thakkar are with us. So let's ask them for some advice. Gentlemen, good morning. Thanks very much for joining in. So it's this whole US legal situation that's suddenly, getting markets excited. As we're gearing up for probably a gap up open, what should the approach be from here on, Mitesh?
Good morning. We have a mild gap up as the GIFT Nifty is indicating, but the broader picture to me still remains when the indicators are flat, and I still don't see any evidence of strength which could suggest that we'll be able to get past 25,015 or levels. So I think on the index, I'll maintain a sideways stance. Closer to 25,000, I think traders can look at taking profits, but try to buy on the lower side, which is about 24,500, and this 550, 560 point kind of range could remain for the next few days to come.
Okay. Sudarshan, how would you look at trade today with this slight gap up that we're set for?
Yeah, good morning. Well, yesterday was a complete no trade day, but I think that markets have changed, at least the atmosphere and the environment has changed today. The chances are that the gap up that we are seeing could be sustained, but we must remember that today's options expiry weekly as well as monthly. Now that can do strange things. But with that as constraint, I would be a buyer in the Nifty today. And this doesn't mean that the market has broken out. We are still locked inside a trading range, but it is possible that we could get that sympathy from worldwide markets. So take a small low risk trade by simply buying call options at the money, and then see what happens. Your stops in the unlikely event that the market doesn't respond is 24,700.
All right, so you'll be buying the 24,800 call?
That's right, 24,800 or 850, depending on how the market's open.
Okay, got that. What about individual stocks?
Well, there's
Sudarshan, you go. Yeah.
larger buy list. AU Bank is a buy. The financial sector has been a favorite for some time, and I hope it will continue. Buy with a stop under 690. M&M Finance is a buy. That's a very interesting chart. A decline, a base building process, and hopefully a breakout. Buy with a stop under 258. I also have Ramco Cement as an intraday short with a stop above 978. And finally, a buy in Metropolis. Buy with a stop under 1637. So 3 buys and 1 sell.
Nitesh, hi, morning. What would your stock calls be this morning?
So I also have 3 buys and 1 sell. I think, on the stock side, a buy on CDSL can be looked at with the stop below 1500 for targets of 1560. Bank of India is a buy as well. Keep the stop at 118, look for targets of 125. A sell on Arvind Pharma. Keep a stop at 1163, look for targets of 1110. And Berlasoft is the final buy call. Buy with a stop below 414 for targets of 440.
Thank you very much for those calls. We'll touch base soon. For now, it's a break. We'll come back with the pre-opening rates. We'll also be joined by Amit Tandon, MD of Institutional Investor Advisory Services, IIAS, on SEBI's order against IndusInd Bank over insider trading. Welcome back. In conversation with Dipan, awaiting the opening in about 17 minutes. Dipan, lots of earnings came out over the overnight. Mid-cap earnings, important ones like Cummins, IRCTC, Bata. Your thoughts? Did you track which one stood out for you?
Not really. I think that none of them really, checked all the boxes and interested us in taking it up as a fresh idea. But, companies like Cummins and all, when the results are a bit down, and maybe the stock price reacts negatively, those are good entry points because at the end of the day, I think, over a longer period of time, these companies do deliver exceptional returns. And it's bang in the middle of this capex cycle and benefits from many other, variables which are in play. And sooner or later, the uncertainty around exports also will evaporate, and that particular segment within Cummins also can do well. So it's good to buy a great quality company with strong competitive advantage when the chips are really down. And 2-3 years down the line, they turn out to be great performers. And there's a lot of comfort in big blue chip names like Cummins.
Okay, that's Cummins. So if there's a dip, buy it. Got that point. What about railway stocks, Dipan? This week on and off, we've seen some interest come back. Yesterday, IRCTC reported numbers. Numbers were pretty decent, actually. Quite steady. But railways, any exposure, any interest?
No, not really. I think it's a great business and, government has been increasing its budgetary support. But unfortunately, last 4 years, the budgetary support has stagnated. And that has resulted in order books peaking out, or rather visibility of order books peaking out for a lot of railway companies. And look, even after a 30-40% type of a correction, there is still very high valuation. But we can discuss one company. It's a really small one. It's called Kernex Microsystem. And when I studied that company, it has, I think, 1,800 crore kind of an order book position for this Kavach. And that's about 16-17 years, its trailing 12-month revenues. Don't look at the P multiples because, that's just crazy because it doesn't make any profits at this point of time. But certainly a company worth watching if they can execute and deliver on that order book position. Having said that, it's a company in which we haven't invested as yet, but it is on our watch list. And at some point of time, we may invest for ourselves and our clients.
Okay, so that's a full disclosure. Kernex Micro, a stock that's on your radar and that you like. But I think we have some metal business now with Nigel. Over to him.
Well, that's right. Jefferies, they have come out with a note. They've initiated coverage on Jindal Stainless. They have a buy rating target price of around 800 rupees. They have cited the company's leadership in India's stainless steel market and the favorable structural positioning. They've also pointed out that the company is the top player in India which is, rapidly growing in the stainless steel market itself. They go on to make this point that the company is well placed as it has lower EBITDA per ton volatility, and they also have a healthier balance sheet if you compare it with any of the carbon steel players. Now, China stainless conversion spreads, well, they are at the lowest we've seen in the last 10 years. Margins could be, though, near a cyclical bottom. So if we see any kind of recovery in the global spreads, that's what could boost Jindal Stainless's profitability as well. What are the expectations from Jefferies? Well, they are expecting the company to deliver 10% volume growth, 21% EPS CAGR, with around a 17% ROE over the next few years. Finally, on valuations, they say the company is reasonable, trading at around 11 times FY26 EV upon EBITDA, given the 25% stainless steel premium over carbon steel globally. So put all this together, Jefferies, they're bullish on Jindal Stainless. They are citing the global factors, the leadership, and valuations as well are palatable according to them. Deepan, what's your view? Jindal Stainless, you don't like the carbon steel players too much, but this is more of a converter. Higher EBITDA per ton. There is some outlook with regard to volumes as well. What's your take?
No, I think it's a good story. And you could also add the fact that more and more stainless steel is being used in building, construction, in improving structures. And then we have this entire Amrit station. Some program is there of the government where they want to improve modernize the station. So a lot of stainless steel can get consumed over there as well. And more there's preference towards using stainless steel utensils as compared to other metals. So yes, it's a good story. And steel companies like Jindal Stainless and all, you hold them for 3, 4, 5, 10 years or so, and they turn out to be great compounding machines. They can easily compound at 8, 10, 12% or thereabout. And if you buy them when the cycle is down, the returns can be even higher. So I think it looks good from our point of view.
Okay. All right. So that's a thought on Jindal Stainless. Deepan, thank you very much.
Deepan, cement has come in your favor.
And now there's a steel.
And now, after a while, on a metal company, you're a little bit positive also, Deepan.
Nigel is thrilled.
Yeah.
You could, if I may say so, you could call it the Nigel effect.
Oh, the Nigel effect. Now the sector seems to be coming in Deepan's good books.
So persistent. He is so persistent. For the time you have to recognize his enthusiasm. Yeah.
Oh, lovely, lovely. Now Nigel breakfast party after the show.
Only facts and figures, Deepan. Cement, we had pointed out in March that it's a global is in a bit of a tizzy. So maybe domestic themes could do well. And I think things have started looking up on metals, anyone's guess. But as you said, and as Jefferies is saying as well, it appears Jindal Stainless at least is better placed in comparison to the steel names.
A breakfast party after the show. Just repeat it.
Whatever you want.
All right. Thank you so much, Deepan. Great conversation. You have a good day, and we'll connect again soon. But back to what was a very serious development last evening. And this was SEBI coming out with an order against 5 key management personnel of IndusInd Bank. These are former personnel, of course, and this is an ex parte interim order that the market regulator came out with, finding prima facie violations by these 5 bank executives, including former CEO Sumant Katpalia. And these are violations relating to insider trading norms. We have Amit Tandon, MD at IIAS, joining in to talk about this. Mr. Tandon, thanks very much for being with us this morning. It's just the feeling, I think the market kind of knows, it's been hearing about these skeletons tumbling out for a while. But yes, this is new. This very clearly tells us that there was malified intent somewhere. It was not just about an inadvertent entry, which is what we thought back in March when the news first came out. This runs bigger than that. And now allegations of insider trading. I mean, materially, does it impact in any way the ongoing process, getting in the new management, and basically getting the bank on track? Does this impact that in any way, or should we look at this as 2 separate issues?
Good morning. You're absolutely right. After they'd taken the big bath and we'd had the chairman speak to the investors, we thought most of the worst is behind us, but clearly more and more is kind of coming out. To my mind, there are a couple of questions which need to be asked. First is, what does it do to the existing structure which was put in place? If you recall, they have an executive committee, and 2 of the members of the executive committee, Sushant Saurabh and Anil Rao, who've been named in the insider trading charges by SEBI, have been named by SEBI. So therefore, the first question to ask is that, look, will will the bank persist with these two people, or is there going to be a big change which will be underway? The second question to ask, of course, is that look, all this is coming out. Of course, we have implications for Sumant Katpalia and Arun Khurana and so on and so forth, but also what does it mean for the board? Were they kind of aware of, they kind of had said in the past that they're not aware of it. But if you read what SEBI said that, look, we've appointed KPMG on the basis of a board note. So again, you have to ask whether the board were shielding the management or whether they were taken by surprise. I think that is really not clear at this stage, and we'll need to hear a little bit more. So if there is action against the board, you can expect that there is going to be some more tumultuous times going ahead. We need to remember that, look, RBI is asking the boards to have direct control over the assurance function. By that, it means they have to look at the internal audit, they have to look at risk management, and they have to look at compliance. And in all these three, it's clear that the board has not lived up to what RBI's expectations were and what the investors' expectations were. So I think we are going to be in for some amount of volatility or internal churn as far as the bank is concerned.
Okay. Amit, so you're saying the board may need to take responsibility, and this could imply a shakeout of the entire board in Innocent Bank?
As I said, things are not at the moment tying up. One of the things which was said was the board was made aware of it only as far as March is concerned, this March. But if you read what SEBI's order has said, there is a reference to KPMG being appointed way back in 23 on account of a board note. Now, of course, you can say the board had done its job then. But the question then to ask is, have they been asking the right questions, saying what is the status of the report, what is the amount? Of course, everyone, and they're right, there's no risk to the bank. The bank is solvent. But it has, the whole thing has become a matter of concern, because if you look at the size of the problem which they were seeing, 1,500 crores, 2,000 crores, thereabouts, it's, for a long time, the quarterly profits of the bank were, before tax, were about 3,000 crores. So it's a significant hit that the bank would take, which is why you can understand why there was some attempt to kind of shield the numbers. And I don't know, they were looking at a wing and a prayer and hoping that, look, some of these, some of this, the market will correct itself to some extent, and therefore the extent of the derivative losses will come down. But I don't know what they were thinking about. But clearly, what it's pointing out to is that there could likely to be a shakeout as far as the board is concerned. There is, of course, the existing board structure, existing management structure, or the leadership structure will change. So the question is, how quickly will they be able to bring in a new CEO? And that in itself will mean there's going to be a round of internal cleaning up. Every bank is going to become much, much more internal focused rather than looking at opportunities out in the market. So I think there's going to be some degree of slowdown as far as this bank operations are concerned.
But Mr. Tandon, that's really the question. Will simply finding a new CEO be enough? Will it really restore confidence? Because like you very rightly are pointing out, there have been lapses at multiple levels. Accounting, risk management. I mean, earlier, like I said earlier, perhaps one could argue that maybe this was inadvertent, some wrong accounting of derivatives, and then there was something in the MFI books. But now, I mean, a willful violation of insider trading regulations. Basically, my question is, what more needs to be done? I was just reading the National Financial Reporting Authority, the NFRA, has also been receiving complaints. So now, is there a need for a wider probe? Is there a need for, I don't know, maybe some sort of forensic investigation? What needs to be done?
Look, the bank has already said that they're going to categorize this as a fraud. So once they categorize it as a fraud, you have the NFRA, you have the SFIO, you have, the auditors, and the current and the past auditors are going to be questioned. So therefore, there is going to be a great period where there is going to be uncertainty with regard to the bank. We've all been in the markets long enough. So we know that if a financial institution loses trust, it does take a long, long time for it to be built back, if it can built it back. Now, one of the things clearly is there is going to be an internal, it appears that one of the first ways to build trust is to bring in a completely new leadership team, revamp the compliance function, revamp risk management, relook at the internal audit. So, as I just mentioned, the bank is Sunday, for the foreseeable future, going to be much, much more internal focused on building some of these trends. Once they're able to demonstrate that, it's only then that the market will start, and by market, I mean retail investors and others, come back to the bank in the numbers or the numbers we've seen in the past.
Absolutely. I mean, there are those in the stock market who are willing to take a quick punt, thinking that this is a distressed asset, let's buy it. But from what you're saying, this could be a much more long drawn-out process before that confidence comes back.
Absolutely.
Okay. All right. Thank you, sir, for joining in. Good to get that perspective from you. Really appreciate it. That's IndusInd Bank. Of course, it's on our radar, one of the top stocks to watch this morning. But let's look at some more trading calls as well. We have Sudarshan back with us. Sudarshan, what's the 910 call?
Well, it's M&M Finance, buy with a stop under 258.
Okay, Mitesh?
I go with the Bank of India for targets of 125.
Got that. Thank you very much for that. Let's talk about real estate. Looks like there is an upgrade coming through for the sector or some bullish notes. Ria joins in for more. Ria?
Well, good morning. Morgan Stanley has come out with a note on the entire real estate space today. What they believe is that top-tier developers continue to show strong momentum, which is supported by improving capital market sentiment as well as favorable policy cues, which includes some potential RBI rate cuts going ahead. They've also highlighted that the real estate sector has corrected by around 8% over the last 12 months compared to a 9% increase in the sensex. And this has been because of subdued pre-sales in the second half of FY25, which has resulted in excess NAV premium unwind as well. They've also said that this reset offers a reasonable entry for some stocks, with the fundamentals still looking intact and the outlook remaining positive for the overall sector. On the back of this, they've upgraded DLF to an overweight rating with a target price of rupees 900. Prestige has also been upgraded to an overweight rating with the target price being raised to rupees 1700 for this one. For Godrej Properties, however, this has been downgraded to an equal weight rating, target price being cut to rupees 2400. Oberoi Realty also has an equal weight rating with the target price being cut to rupees 1700 for this one. And for Macrotech Developers as well, an equal weight rating with a target price of rupees 1400.
Thanks, Ria. Let's hop across to Vamshi. She's here to squeeze in a quick word on Cummins. Vama?
Well, Nigel, when we look at the revenue, it was missed as compared to what the street was anticipating. The street was working with double-digit kind of growth, but the growth this time around has come in at only 6.4%. This is largely being dragged by the domestic business, which was largely flat on a year-on-year basis. But the exports business, that did quite well. The exports saw an uptick of almost 39%. And this is the second consecutive quarter where we've seen an uptick, year-on-year uptick in the exports. As far as the operational performance of the company is concerned, that was quite good. Keep in mind that there was a one-time gain in the previous quarter. So that seems to have, sort of the base quarter margins have been pushed up because of that. And therefore, we were expecting margins to contract, but by, not such a big amount. And this time around, the margins have actually come in much better than what the street was anticipating. The net profit has seen a decline of 7.2%, but this is again much better than what the street was working with. They're witnessing some partial recovery in the export demand. They are hopeful that this positive trend will continue. They're cautiously optimistic about the momentum in the domestic as well as the international market as well. Con call is scheduled at 10 a.m. today, so we'll be watching out for the commentary that comes through from the management as far as FY26 is concerned. So largely, when you look at the Cummins numbers, an operational-led beat.
Stocks up 1% in the pre-open session right now. Thanks very much for that, Vamakshi. The market overall, we're going to start exactly what the implied open was suggesting with this 70-point up move. And the mid-cap index up about 0.5% at this point in time. So let's see. Some of the metal names are actually looking quite good. Tata Steel, JSW Steel, all these stocks on the high side. I think globally it's a bit of a risk-on day, thanks to this, court situation in the US. And therefore, we're seeing, dollars up, equities are up, metals are up, and this is what's playing out. Just a couple of minutes to go. Watch out for tech as well, by the way, because of the excitement around NVIDIA. Nasdaq futures are substantially higher. Tech stocks, let's see if they can retain
global
their
facing
mojo.
indices will be in focus.
Global, metals, tech. That's how we start the morning. Okay, the bell's going to go off any second now. And we are opening with this 70-point up move. Make that 100 the moment the bell went, and it's actually a 100-point gap up opening, so looking very good. 24,850 on the screen, inching back slowly towards that 25,000 handle. And global facing, that's how it is. JSW Steel, 1.6%. Tata Steel, about 1.2%. Then you have all of tech. Infosys, 1.5%. You've got, names like HCL Tech, Wipro also higher. Let's not forget, stocks like Tata Motors. Easing tariff worries, obviously good news. US is a big market for that company. So that stock's higher as well. Banks actually in sync with the Nifty now, so not too bad. Axis Bank, for instance, up and about. IndusInd Bank is not reacting to the SEBI announcement. This is, quite understandable, frankly, because these, Mr. Sumant Katpalia has anyway been moved out. He is no longer the current CEO. And they will have to, these 5 individuals will have to sort of, deal with the market regulator independently. From here on, it's about rebuilding the business. So the stock, not too perturbed at this juncture. Actually, most Nifty stocks are positive. The only negatives are Tata Consumer, Bajaj Finance, that's about it. But this is a good morning, galloping away 120 points higher.
By the way, Tata Consumer has gone ex-dividend by 8 rupees 25 paise. So that explains the cut on Tata Consumer, Nigel.
Okay, all right. Well, a few stocks, though, that are calling for our attention. Avanti Feeds, that one, in fact, is a bazooka move this morning. Big uptick is what you're seeing on Avanti Feeds. I think it's reacting to its set of numbers. So good reaction out there. The EBITDA number came in high by closer around 36%. The margins at around 12.5%. The street likes it. The other stock that's doing well is Wellspun Corp. We told you earlier today, the margins have improved. The EBITDA per quarter is the best that we have seen in numerous quarters. Good order book and net cash in the books. The street likes it. Sale as well, the volume growth of around 17%. Well, that was much better than what the street was working with. They have released some working capital. The street likes that as well. Marginally up, closer to 100%. IRCTC, I think that one as well had a good start to trade. So that should come up for you on the screen. IFB Industries, that's the other one of those bombed up names. But the growth out there was quite good. Margins didn't look that good. But, the growth out there was good. It was better than one of their competitors as well. So I think that's why that stock is up close to around 3.5%. Invero Infra, that's the other one that's up close to around 4%. Big volumes out there. So though you have, the headline index that's up marginally, you have from the broader markets, lot of earnings reactions actually, and the stocks are off to the races.
Okay, some more then. Wellspun Corp, 4.5% higher. Mishra Dhatu, Deepak Nitrite. Prestige Estates is also open with a 2.5% uptick. As the company says, they've completed 3 Mumbai projects and they will be handing over 700 residences and 130 office units. And plus, there is that bullish note coming through from Morgan Stanley on the entire real estate pack. So Prestige Estates has started off with some strength. Cummins, we were just talking about it, 2.5% higher. Berlasoft, revenues were soft. The company's top line declined by 5% on a sequential basis, but the company managed to expand their margins and the street is reacting to that. And generally, there has been an uptick in most of the IT names. I think one of the big drags today is Bharat Rasayan. And that is, I think, on the back of numbers. EBITDA for Bharat Rasayan is down 42%. EBITDA margins 13% versus 22%, and that stock straight away, it's tanked close to about 8%. The other one is Balaji Amines. Again here, there is a margin decline. Margins have sharply come off. The overall EBITDA is lower by 39%. Street doesn't like it, and it's getting punished to some extent. Bata was a lackluster set of numbers. The stock isn't doing too much, and Max Financial is reacting to the surprise CEO exit. Mr. Prashant Tripathi will be stepping down, so Max Financial has a 2% fall to begin trade.
Okay, so lots of stock-specific action, but overall as well, it's a positive morning, 100 points straight away up. Well, time to then get to our market masters of the day. Bank of America Securities 2025 India Conference has kicked off. In fact, it will kick off actually next week. The focus is going to be on growth, acceleration in India. So let's discuss the view, the house view, then just ahead of that conference with Amish Shah, head of India Research, and Arvind Maheshwari, head of India Equities at Bank of America Securities. Gentlemen, morning, and thank you so much for joining us in person in the studio. It's always a pleasure to speak in person. And I was going through your note, Amish, you and your team's note, 9 structural drivers for India, right? Sounds fantastic. So I think in the near term, you folks are slightly cautious, given the run-up, given the valuation. So let's just start there by understanding the top-down house view on the near term. Then we'll come to the 9 drivers.
Sure. So look, near term, we had set out a target for Nifty at 25,000 for December. I think we are right about there. So we think markets are now likely to mostly consolidate as far as Nifty is concerned. Valuations are full. Clearly, we can't fault the long-term drivers or the growth in India. Macro story continues to stay well. But 21 times at Nifty, it's almost at +1 standard deviation. So if you're a near-term investor, our advice is that maybe start booking some profits. If you're a long-term investor for a 2 or 3 year period, then the view is that you should expect muted returns going forward.
Wait, but you're saying that maybe the best is over for the calendar year, despite the fact that look at global markets. And it's tough to call these things, but now the courts are challenging Mr. Donald Trump and markets are rejoicing it. There's so much still going on.
And Surabhi, there will be therefore some excitement to the markets in the near term. But if you would recollect, we were always pricing in that India will go through a trade deal quite soon. And there'll be benefits of China +1 on the back of that. So there has been some market rally on the back of that already. So some sectors which were going to be more impacted, like autos, maybe pharma, IT, on the worries that US economic slowdown could cut down on tech spends. There might be some rally as a relief as of now. But beyond that, India was never pricing in for a Trump tariff impact. And logically should not get, a big rally on the back of that either.
Fair enough.
Amish, just to complete the point about the way markets are going to move now in the near term. So we're in the last leg of the rally, at least for this year. 25,000 is your Nifty target. But your note also talks about 5 emerging risks that make you cautious. So tell us about that. And is there a risk of a downside from here on? Could we see some derating?
So, Rima, think of it like this, that if you were bullish markets, I'm sure you are going to talk about 5 factors, which is there is lower crude, weaker dollar, there is ongoing monetary stimulus, there is a possibility of a fiscal stimulus on the back of extra RBI dividend and excise duties on fuel, and you could possibly talk about the India-US trade deal going through, or maybe the tariffs not existing anymore. All of these put together, therefore the bullish view is that growth will accelerate.
Correct.
And we completely agree with that view. The problem is that this is only half the view, because growth will accelerate is a directional view. The moment you start to quantify it, our problem is that we think that whether you talk about capex growth, consumption growth, corporate earnings growth, credit growth, all of them will have a shallow recovery in comparison to what markets are already pricing in. Take, for example, Nifty in FY25 has delivered 5.5% earnings growth.
Okay.
We are expecting it to go up to 9 in F26, but the street was at 22, has scaled down to 14, but it's still 14, not 9.
Correct.
Same goes for capex and credit and consumption and so on and so forth. So the worry is that every result season, therefore, acts as a market correction event because earnings will keep on disappointing. So that's the first problem. The second risk that we see is that over the next 12 months, there are 6 state elections, starting with Bihar in October. And I think that will lead to a re-acceleration of populism, which is something that market never likes. Second concern. The third concern is that, yes, there is a tariff scale down, but then there is a re-appeal to that. So the point is that the global macro and geopolitical uncertainties are not gone. They will keep markets volatile, right? So when you club it all together in the context of full valuations for Nifty, maybe at almost +2 standard deviation valuations for mid and small caps, the room for error is limited. And as a result, when we are saying that the markets will consolidate, obviously it's not going to be a straight line.
Yeah.
So depending on the news flow, you will have a little bit of a volatility. And actually, we've been using that volatility to our advantage quite well. And I'm not trying to claim credit here, but because we knew that market fair value is 25, when the markets were at 26,500 back in August last year, we were negative, and we were calling for a 17% downside. When the markets actually came down to 22,000 in March of this year, we upgraded markets with the price target remaining the same as 25,000. Okay. And we played for that 15% rally. Now that the markets are at our price target of 25, we are asking investors
to this range stays 22 to 25 broadly, or 26?
So 22 now, I think, will really require some big macro or a geopolitical event. There is nothing in the horizon right now. So I think a pullback as sharp is unlikely. But could there be a +5, -5 kind of a trading range? Quite possible.
All right. Hi, Amish. Hi, Arvind. Welcome to the studio and all the best for the conference as well. So you're sounding far more, skeptical about the markets as of now, a little bit cautious at least. And kudos on that call. I recollect, when we were at lower levels, we were calling for 25,000 odd. That said, one thing that's keeping the markets afloat is this strong DII flows. But you all are calling out peak DII flows. Explain that to us. What's the rationale? I mean, because everyone talks about this financialization theme, a larger number of people contributing, but you all are calling this out. So run us through that.
So Nigel, if you look at the number of demat accounts in India, just 5 years, like January of 2020, before when the entire rally of the markets has started or the financialization theme has started, we had about 2.7% of Indians investing in equities, right? That number is now close to 13.7%. So there's more than 5-fold increase in terms of the number of investors in equity markets. Now, I can explain this in a variety of ways, but let's say loosely speaking, you talk to any consumer discretionary company, they would tell you that 20% of India is the real market, right? So 20% of India has some discretionary income to consume something discretionary. It is only logical, therefore, to assume that if you have some discretionary money, only then will you go and invest in equity markets. Otherwise, the money that you earn is just catering for your basic needs. So if the cap is going to be at 20 and you are already at almost 14, the acceleration from 14 to 20 now is going to be slower versus an acceleration from 3 to 14. The second point to think about it is that obviously the investor who came in at 3 to 5% was richer and had more disposable income to invest in market as compared to the 14 to the 20th guy, right? So the per capita dollar that an incremental investor will now invest is also going to be lower, right? And given the valuations that we are, as we are discussing, clearly Indian retail investor is also quite smart, and that is reflecting in numbers. So if you look at markets peaked in September last year, domestic inflows peaked in October last year. Yeah. So October inflow number was $8.6 billion a month. That number since then, if you track from November, December all the way to now, has been between $4.5 to $6 billion. So markets peaked, flows peaked. Obviously, if they were to go back to 22,000, I'm sure there will be a flood of money coming in. So a retail investor will buy the dip. He will try to sell the top. And in that context, I would say that the pace of acceleration of flows that we've seen in the last 5-6 years, the pace slows and the pace now becomes more volatile versus a secular trend earlier.
That's a very interesting trend that you've noticed, absolutely. And I track those flows here. Every month the mutual fund data comes out, and you're right, 41,000 crores of inflow coming in around Diwali, and now we are down to about 25,000. So that's an interesting point. When markets fall, people keep buying. I think that's the new normal. But Arvind, let me come to you as well. Tell us a bit more about the expectations from the conference, and more importantly, we're in an environment where there is a lot of expectation that globally investors will look away from the US. They've been very US focused all this while. Now money needs newer homes. Are you hearing that within your ecosystem? And then how is India stacking up? Because the Chinese market has the advantage of valuation on its side. Much, much better. They don't have the problems that Amish just described. So, what is the expectation from the FPI fraternity?
Sure, and thank you for having us here again. It's exciting times. There is massive interest in the conference. Last time was a super successful event, and this time it's bigger, it's better. And hopefully we'll have you at the conference as well. The number of investors is just testament to the fact that investor sentiment, despite all of this caution, is still very, very alive and kicking. Some of the themes, like you mentioned about the demand for non-US dollar assets, I think it's just about starting. And it's going to remain that way for a while. It is clear President Trump wants a weaker dollar, and we are not going to fight it. So you will continue to see demand for non-US dollar assets increase. And when we look at emerging markets as an asset class, that itself becomes a very interesting play on the back of that non-US dollar demand, because you saw from, even from mid-24, the outflow numbers were massive. Now, April to date, since what is called now the Liberation Day, that when the tariff noise started, we've seen about $19 billion of inflow in emerging markets. And what we saw as outflows from the middle of 24, only 20% of money has come back so far. So I think there is still room for that to grow in terms of inflows from emerging markets. And then India being at the heart and center of now the emerging market indices, I think there will be increased amount of passive allocation anyway coming our way. And plus, whoever is looking at benchmarking against the emerging market indices, I think India becomes a very sort of safe haven. So yes, valuations are one part of the problem, but if you look at top-down macro, it's hard to find fault with India at this point. And I think that story is going to be, there's not too many large pockets of investment opportunities in the world outside of the US that will be able to absorb capital.
You know, for the benefit of our viewers, I just want to call out the 9 themes that you've singled out in your latest report. And these are medium-term structural themes for India that Bank of America Securities likes. Rapid infrastructure build-out, productivity gains, digitization, financialization, the resilience in household savings, the shift in discretionary consumption, formalization of the economy, the current account moving from a deficit to a potential surplus, and decarbonization. So all of it tying in together to present perhaps a solid medium-term picture for India. Based on this, I mean, either of you gentlemen can take this. Which are the key highlight themes that you plan to call out in the conference? What is it that, as a house view, that you're most optimistic on? Is it renewables? Is it power? Is it what's the new sunrise sector, or even if it's an old sector, and what's the sector of the future?
So I can take that, and maybe Arvind can chime in. So see, first of all, I think Surbi, the good news is that some of these themes have been playing out for a while, but now they are coming together. So a confluence of them coming together, I think, can have a bigger impact. So to some extent, they are all connected. So let's say, for example, India is doing a lot of capex, but how do you fund that capex? So when you have household balance sheets getting better, and then they go back to savings, that saving then in turn funnels into funding the investments. And then that once the infrastructure kicks in, then you have the productivity gains to it. The formalization of economy is equal to larger, better, bigger companies growing market share at the expense of unorganized players. Unorganized players, as we know, were leaking taxes. Organized players pay taxes. So then the government gets more money, and the government then wants to use that money into productive use. So a lot of these things I'm just trying to say is that it's connected, and when they come together, it's a even bigger or a powerful theme. So when I started my career, I recollect there was a perennial complaint about India running twin deficits. Like we are a current account deficit and a fiscal deficit country, and as a result, we had higher rates, higher inflation. Currency was always a problem. We don't talk about that anymore. Currency is stable. Little bit up and down, it's fine, but it's markets. But otherwise, currency is stable. Rates are quite low. The gap between U.S. Treasury and our Treasury has been the lowest ever. So all of these are macro benefits, and it just makes cost of doing business cheaper. And when the cost of capital is cheaper, obviously, there are more businesses that become viable.
But you're still saying 25,000 on the index.
Yeah, meaning if I were to put a target up until December of 25, which is in the here and now, because meaning unfortunately, as we know, markets is nothing but EPS multiplied by valuation multiple. Valuation multiple for 10% EPS growth is already at 21 times. How much more are you likely to pay? We are already at +1 standard deviation. So I think the good news is that a lot of countries globally don't have that structural theme. Yeah. So at least India is a structural growth story.
We have the background. I mean, the backing.
Amish, for the longer term, India is good. Come on.
Absolutely.
I'm putting most of what I earn into the Indian market.
So Nigel, in fact, I would support it with a data point. Yeah. We looked at India 15, 20, 30 years. Yeah. You'll be surprised that after US, India is the only market globally to have delivered the best market returns in US dollar terms.
Yes.
So despite the rupee depreciation, second largest return generating market. And over a 10-year period, India is the highest number of stock compounders globally.
Wow.
Right. So clearly, there is need to find the bottom-up ideas, There will be compounders, market will grow structurally.
Yes.
But for the near-term investor, 25,000 is a full price.
And also just one more point on that, because the SIP investor, I think only in the Indian markets and the United States have made a lot of money. So keeping your SIPs going, that's something that our retail audience obviously, looks for some guidance on. I personally do that as well. So keeping your SIP going, the longer duration, maybe the near term we're hitting a peak on the headline index, but longer duration, India should do well. Another quick point, since you all were talking about this rate easing cycle, a couple of sectors will do well. One such theme you all are pointing out is autos. Could we narrow down a little bit, because the rate easing cycle will give more amount of money in the hands. You have the tax cuts as well that are coming there. So what do you like from the auto pack? Either of you all could take it. So,
and I will broaden that answer to some extent, Nigel. We are of the view that economy needs a stimulation. Unfortunately, there is not too much of room from a fiscal side to stimulate right now. Therefore, large part of the onus is on monetary. Yeah. Monetary, there are plenty of tools and the government will use it, or the RBI will use it. So because monetary stimulus will continue, we are broadly positive on everything which is rate sensitive, domestic cyclical. So that includes financials, autos, as you mentioned, REITs, real estate, some internet. So this is all that we like. Within the auto space particularly, we are more constructive on the passenger vehicles right now, followed by two-wheelers. Given that we think that the infrastructure growth is relatively going to ease, we are not that optimistic on the commercial vehicles as of now.
Arvind, CapEx has been a big theme for our markets. It's, stocks have done very well. In fact, it's one of the 9 structural ideas for you, good infrastructure rollout. Yet you are underweight on CapEx-linked plays like industrial cement. Why is that?
So, look, ultimately what Amish also pointed out earlier, if there is elections coming up, there is more populism, generally that money goes away from CapEx into doing these kind of measures. And it becomes harder then for, anyway, execution challenges remain in that segment. So as much as we want the CapEx push to be there, you have to be able to execute the allocated outlays. And if that doesn't come through into execution, ultimately the growth challenge then becomes a bottleneck. So which is why to what Amish was mentioning about the money tracking financials and autos, rate sensitives, and we are seeing that in April to now, whatever money flow has come through from foreign investors, you can already see more than 50% has gone into financials if you track the data. So clearly the market also wants to be where the policy support is going to be.
You're also cautious on momentum plays. What would you classify as momentum plays? Would it include, say, for instance, defense, which has had a fantastic run up until now?
I'll let Amish take that.
So, Rima, the short answer is yes.
Defense is one. What else comes in momentum? And then tell us more about it.
So I would say defense, SOE pack in general, railways, industrials, power utilities. Primarily, the bigger definition of it is CapEx-linked stocks. So as Arvind mentioned it, if I were to just put some numbers to it, central government CapEx between 21 to 24 was growing at 30% CAGR, is now likely to grow at 10. State government CapEx was growing at 21% CAGR, is now likely to grow at 8 or 9. Right? The overall CapEx pie was growing at 20% CAGR, is likely to now be at 10. So there is a rapid scale down in terms of growth or the second derivative that we are talking about. On the other hand, subsidy bill of India, states and center put together was $91 billion back in FY23. FY24. In 2 years' time is expected to be $127 billion. So there's a 40% increase in a couple of years' time.
And this moderation in CapEx, is that a structural theme? Because it'll keep putting a lid on stocks that you're talking about.
So in terms of the growth rates, yes, given where the tax collection growth rate numbers are. Meaning, is there a stoppage to CapEx? Not really.
No.
But are we in the era of growing at 20+%? We are not in that phase anymore, right? So the nominal GDP will grow at 10, 11. I think CapEx will grow at the same run rate. So if you had an economist in the room, he would argue that, CapEx as a percentage of GDP is at least a flat line. It's not shrinking. So why are we complaining?
It's the alpha.
The CapEx analyst in the room will argue that, the growth is down from 20 to 11 and therefore stocks needs to adjust to the valuations therefore.
I'm glad you brought that up, put it on the table before anybody could ask, counter questions. Finally, gentlemen, where are you on the mid-cap, the SMID versus large-cap universe debate? Because the narrative so far this year, and it's played out, is that large caps offer a lot more value. Just stay with the big boys, and that's where the money is. How do you see it now?
If I take a fundamental cap on, then I clearly think that SMID caps are more expensive than the large caps. There are various ways to argue it. I will just give you a couple of data points. In the last 3 years, the growth premium of small and mid caps over the large caps was 16 percentage points. 16% extra growth. Okay. So clearly that justified valuation premium. Yeah. Right? If you go into the next couple of years, that growth premium is going to shrink to 400 basis points. Okay. But the valuation premium at the peak was 50%. Right now is at 45%. So growth premium has massively shrunk. Valuation premium has hardly shrunk. So from a fundamental basis, I would say that large caps are cheaper, mid caps are more expensive. But from a flows perspective, till the time the money continues to rotate into small and mid cap mutual funds, as a mutual fund manager, what choice do I have but to chase the same stocks and bid them at higher valuations?
When money comes in, all bets are off. Then all arguments fail, right? You don't stand in front of a moving train.
There is a lot of supply of paper as well coming through, right? So that is, and that will, once the large caps and the big boys have raised some money and that is out, you will see a whole host of mid, small cap names also. And look, I think
I'm glad you brought that up, Arvind. Could that put a further lid on the market's excitement because there's so much of supply in blocks on a daily basis? There are IPOs coming.
Look, I think at some point it will be a cause for concern, but I think we are starting out from a very low base, right? We had a very dry Jan to April. So 4 months, literally, we had like $1.65 billion in cap raises in deals across all segments, whether it was IPOs and blocks, etc. Now, this is the first month in May where we have seen almost $5 to $6 billion. Now, if you recall, second half of last year, we had almost $7 billion every month. And ultimately, obviously, that at some point started to fatigue the secondary market. So I think it's still early to call that a reason for concern. And obviously, as the market expands, the free float expands. I think we want more companies listed. There are some great stories in India. We want them to come into the listed space and get all retail investors to be able to participate as well. So I think it's great for a great outcome structurally for the markets longer term.
Okay, all right, gentlemen. Good hearing your thoughts. And in fact, on that point, it could explain why the mutual fund industry was sitting at such elevated cash levels. I think it was around 2 lakh crore. Pure equity AUM as a percentage are around 7%, so prepared for some kind of supply. But thanks a lot for coming down. We take your thoughts on boards and wishing you all the best for the conference. Look forward to having you all post the conference as well. All the best, gentlemen.
Thank you, Nigel.
Thank you.
Well, time to slip into a short break. On the other side, we'll get chatting with Vishal Goel of UBS Securities. We'll talk about the Indian banking sector. Stay with us. Welcome back. Well, the market's still holding with some mild gains, though we have come off the top of the day. But there are plenty of stocks actually from the broader markets that are doing well. Federal Mogul Gods, after a while, this one's come on the radar. It's up 15%. Vito switch gears, well, that's up close to around 15%. So I don't know what's going on there. Wellspun Corp, the one that we spoke about earlier today, well, that's making almost on the verge of making a fresh 52-week high. So broader markets, plenty of stocks doing a thing of their own. But as promised, let's focus on the banking universe now. Are banks back to the golden era? Are asset quality woes, unsecured lending concerns a thing of the past? Let's discuss this and more with Vishal Goel, the head of India Research and banks analyst at UBS. Hi, Vishal. Good morning. Thanks a lot for joining in. Well, before we get to talk about PSU, private banks, and the entire industry, I just wanted to ask you about credit growth. That's yet to show signs of picking up. In fact, it's moderated in the last few months. What kind of credit growth are you all working with? And if you could tell us, do you expect things to pick up from here on?
Yeah, hi. Thanks for having us. Clearly, I think the impact of tightening, which we have seen in last years, plus the growth slowdown, which we saw in the last half, it's reflected in the slowing credit growth. I guess from here, like from the current 10% number, we are expecting it to go towards 12% by the end of this year. Multiple tailwinds we have for credit growth this year. We have the consumption stimulus from the government, which should start, reflecting somewhere, this year. Also, the liquidity easing that also enables banks to start lending more than what they've been doing. Clear constraint has been deposit growth. That also generally would start improving towards end of this year. And also, I think if you look at the risk weightages from RBI recently, they have in fact relaxed all those. So the overall environment, especially from the regulatory point of view, is easing plus liquidity. I think this should start, reflecting in the credit growth over this year.
Vishal, thanks for joining us from the sidelines of your conference. Thank you very much. This is Rima here. Last month, you all turned bullish on some of the PSU banking names. So I can see an upgrade on SBI to a neutral, an upgrade of Bank of Baroda to a buy. Tell us the thinking on PSU banks right now. What's the narrative playing out?
Yeah, hi Rima. See, I think we've been cautious on PSU banks, especially due to their lower profitability and their ability to keep profitability. So they gained because of falling credit costs. Generally, their operating profitability has remained weak. We have reached a point where their profitability, especially in terms of core PPOP, is stabilizing. Plus, there is no major pressure from corporate lending. Also, their exposure to retail unsecured is generally small. I'm talking about the overall pack. And I think all those, again, gives us some confidence on their credit cost. And valuation, given their underperformance, I think have become reasonable. So those were the views from cautious to more like a neutralish view on state-owned banks. We still prefer private sector, banks, as a pack in terms of overweights, just to clarify that.
All right. Speaking about the bank that's been in focus for a variety of reasons, may not be the best, is IndusInd Bank. And a lot of news flow out there. But a stock that was at around 1,600, today it's less than half that price. Give and take everything, do you think bulk of the bad news is in the price? Or do you think things are too fluid and, there could be a negative surprise coming out of somewhere that you'd rather stay away?
Yeah, Nigel, sorry, I'll not be able to discuss stock specific due to, our internal compliance. I think, yeah, so maybe I can make a general comment on the industry, but maybe not stock specific.
But do you want to make a general comment on IndusInd Bank? Will this have any kind of ripple effect? Because what we're seeing right now is that incremental bad news is not further hurting the stock price. Like, for instance, today there are allegations of the SEBI investigation throws up insider trading. It's not that the stock has fallen further. So, I mean, from a shareholder point of view, how should they go about thinking about a stock like IndusInd Bank without getting into specifics?
See, yeah, again, I think without discussing stock specific, I'll tell the way I would look at this is we have had similar cases in the past, right? There have been a couple of such banks who went through a similar journey, I mean, in a different form, but they had serious losses, change in management, regulatory interventions. And post that, what typically happened is you see a consolidation in metrics, like the growth disappears. The focus goes back in terms of protecting the depositors versus shareholders. That generally is the script from regulator. And in generally the period followed by maybe 18 months to 24 months, in that period, you typically see no activity, from such companies. In terms of growth, generally it's a cleanup period. So that's been the case in previous, similar cases.
Any big anti-consensus call, by you, not on stocks, but even in terms of a trend? I can see Bajaj Finance, for instance, is a sell for you. And that seems anti-consensus to me.
Yeah, see, again, I think if I think about broader sector themes, the way we looked at is we've been cautious on the sector for last 12 months or more. We turned constructive, recently. And clearly there are reasons for that. I think when I say anti-consensus, probably when I look at valuations, which is still below average for the sector, I think clearly there is room for making money in this sector. And we think the regulatory landscape is turned favorable for the banking sector. Like we have seen multiple tightening in the last 2 years, which is getting now relaxed. If you see, incremental last 3 months, I feel more relaxation could come through in the next maybe 12 to 18 months. Second, I think the consumption credit cycle, the unsecured credit cycle, that also has seen like NPL buildup. It's probably in the last stage of cleanup in our view, as per the data we are seeing. So the pressure on credit cost also should start easing from here. The only thing which is left is NIM compression due to rate cuts. That I think will have to factor in this particular year. But otherwise, I think if I look at the compounding on ROE, I think the sector should be comfortably compounding at anywhere between 13 to 15% on ROE and reasonable valuation. So, yeah.
As a house, how many rate cuts are you all factoring in?
See, our economics team is expecting 75 bips of additional rate cuts this year.
Okay, so Vishal, hi, Surabhi here. Just to kind of recap the main headlines from this. For this year, what is your expectation of credit growth system-wide, banking system-wide, given the rate cut expectations? And just purely in terms of growth, which kind of lenders could be ahead?
Sure. See, we are expecting 12% credit growth. So this 10% should improve towards 12%. That's our view on the credit side. We feel consumption credit would drive this growth because we have seen multiple, I would say, stimulus waiting actually to come through in the next 12-18 months. That should support growth. Falling interest rates, the housing cycle itself, that also should accelerate towards the end of this year or second half of this year. So a lot of, I would say, growth will be visible in the second half of this year in terms of loan growth.
So finally, for this year, the next 12 months or so, the biggest driver of stock prices, of course, is going to be, the credit metrics, credit growth itself. What else to watch out for? What will be the biggest factors that will lead to perhaps the best delta in stock prices, whether it's banks or non-bank lenders?
Sure. See, I think growth will be, as you said, will be the biggest factor because we've been seeing lack of growth for some time. I think the second factor will be stability in net interest margins because currently there's a lot of uncertainty around how much the NIM would fall due to the repo rate, basically how much banks would be able to retain, right, or offset versus the repo cuts. So that stability also will be reassuring because then people will have some visibility on FY27 NII and FY27 NIM. And lastly, of course, the last leg of unsecured credit cycle, that's still going on. I think the incremental data points are encouraging, but once we see that kind of fully stabilizing, then banks will also be able to grow the unsecured credit with more confidence going forward. So that's the other data point to watch out.
Thank you, Vishal. Great conversation. Enjoy the rest of your conference. Look forward to the next one. Now let's get in a corporate conversation. EID Parry. Now the Q4 revenue saw healthy growth, but margins were under pressure. For FY25, most of the businesses did well, barring the sugar business, where there was a revenue decline of about 13%. The sugar business also reported losses, and that's on account of the lower crushing. So how is FY26 shaping up for them? Let's connect with Muthu Murugappan, CEO at EID Parry. Thank you very much, sir, for joining in. This is Reema here. That's the first question. In FY25, except sugar, the rest of your businesses did pretty well. So, for instance, distillery revenues were up 38%. The consumer products business revenue growth was 25%. Nutraceuticals saw a growth of about 18%, but sugar was subdued. For FY26, how would all these individual segments fare for you?
Very good morning, Reema, and thank you for having me on the show. Yes, it was a challenging year for the sugar business on account of lower cane availability, primarily in TN and AP, and also lower cane recoveries. I think this impacted our sugar segment performance. Looking ahead to FY26, I think challenges in TN and AP continue. We are hopeful that planting will improve, in the upcoming season. But for this season, we do see challenges continuing in TN and AP. However, Qatar, which is about close to 60% of our crushing capacity, looks much stronger. So that.
Okay. So, sorry.
There was some sugars. We are seeing good monsoons. They've in fact started early.
I think that line is slightly that line is slightly patchy, Mr. Murugappan. If you could just recap for us. So you've done, in terms of sugar revenues, this year you've done 1571 crores, which is obviously a decline from last year. The current year, do you expect some of the crushing issues to come back on stream? What is the sugar revenue that you're hoping to achieve this year? If not revenue,
so the upcoming year, we're still.
Yeah, please go on.
So we're still, more cautious on the we're still more cautious on the upcoming year because of lower cane availability in TN and AP. Also, we're seeing a trend of release quotas, coming down. So from the sugar perspective, it could be a challenging year going forward. Karnataka, however, looks good, from a crop perspective. More broadly, I think monsoons are there, and I think they are expected to be normal. So this should strengthen the general availability and capacity utilizations across the sector. From a price standpoint, given that there's likely to be more sugar in the domestic balance, pricing might correct. But then again, we'll have to see what kind of policy interventions are made on exports as well as on ethanol. And hopefully positive interventions here will bolster pricing. But we're still, quite cautious and rather neutral on the sugar segment.
Okay. All right. Hi, Muthu. Good morning. Good to see you. Nigel on this side. Give us a couple of details then on the distillery part of your business. What kind of volumes did you do last year? And since I think you have some capacities that have come on, FY26, we should see a bit of an uptick in terms of volume. So if you could give us a brief number in crore liters.
Sure. Thanks, Nigel. The distillery was a good story last year. We did about 16 crore liters of volume. Some of our capacity came on stream.
Okay.
And
for the coming year,
in F24, so that was a good growth.
If I got the numbers correctly, sir, Muthu, it was 16 crore liters last year.
That's correct. For F25, it was 16 crore liters. F24 was 12.5.
Okay.
And the upcoming year as well, we should see a slight uptick in distillery volume. However, on the margin front, we have seen some challenges. Challenges on account of ethanol pricing, that hasn't changed. The offtake pricing hasn't changed for close to 3 years now. Also, given we had lower cane feedstock, this increased input costs. We had to insource a lot of molasses, which was quite costly. So this has impacted margins. We're down to about 8% on EBITDA margin, as opposed to 12.5% in F24. And we expect this 8% trend to continue. Ideally, if there are some positive policy interventions, this could move higher.
Okay, all right. Just a couple of questions. From 16 crore liters, what should you end this year with? 17, 18 crore at least? Should that be a doable number? Is it higher? And also, you all made a pitch for this ethanol price hike, right? What is the quantum you all were looking forward to, and how optimistic are you all about that seeing the light of day?
Sure. So in terms of volumes, I think we should comfortably move to 17 crore liters. And, I think if there are positive policy interventions and some improvements in cane planting, that could, go even higher. In terms of ethanol price, I think industry has made some representations. I think the policymakers have, given us detailed hearings. I think industry representations have been to the tune of 4 to 5 rupees. However, we'll have to see where that lands. Policymakers have been receptive to our representations. We remain hopeful.
Muthu, the ethanol price in the last year, November 1 to October 31st sugar year, that was 57.97 from what I'm seeing right now, basically around 58 rupees. Would that be right?
For B-heavy molasses, yes.
Okay. Now, which is the feedstock which you use? I mean, because you're saying that distillery, the volumes are fine. The top line is growing. The problem is with the margins. So what kind of a price increase would make it more viable for you? And also tell us about different feedstock. I don't know if you're using maize, for instance, because there was an increase on maize as well.
So we use three feedstocks. We use B-heavy molasses. During the crushing season, we use a little bit of sugarcane syrup as well. That pricing is about 65 odd rupees. We use maize as well. Maize is about 71.8. Maize is about just under 20% of our capacity. It's only one distillery which has maize capacity. So we use these three feedstocks. Ideally, on the sugarcane-based feedstock side, it would be good to see an improved offtake pricing. I think we would resonate with the industry ask of about 5 rupees here.
And I mean, assuming this is an assumption, where would the margins be if, let's say, the industry got what it's asking for, which is about 5 rupees? I mean, as of now, what is the projection minus any ethanol price increase? What's your projection of margins for the distillery business? And how much could they look better if there is this price increase that comes through this year?
So Surbhi, as mentioned, I think we will hold margins at 8% if nothing changes. If I take you back 6 to 7 quarters, I think we were around 20-21% EBITDA margin, and we were quite comfortable. It would have moved slightly north, if that trend of offtake prices was going to move up. And we were very happy with that because we, just coming off a significant capex program on ethanol. And I think this would really keep our payback aspirations in check. However, with these margins of 8%, I think there would be challenges around the payback periods. If there is a price increase to this tune, I would say the margins would move back into the late teens.
Late teens, okay. That would, of course, your shareholders would really like that. So it all is now hinging on this price increase for ethanol on the B-heavy molasses. Muthu, I just want to come to your other business, which has been growing really well as well, and that's consumer products. I mean, there the revenue from about 530 crores has grown this year to about 880 crores. So it's a substantial increase. Give us an overview. What can we expect from this business? Any new likely launches? And again, the margin profile that you're aiming for this year, for this business.
So I think, Surbhi, this is a new business which we're building for the future. We have a multi-decadal view on this. It's really in branded food FMCG. We started off with sweeteners, and if I was to focus on the sweetener segment first, I think our branded white sugar volumes are holding stable. We've put a lot of focus in on the value added, especially the browns, which is jaggery, brown sugar, etc. And I think that has grown. Our value added component is about 12% of overall sales. This is, of course, margin accretive. And also with the trend of consumption of sweetener moving towards more healthier sweeteners, this is in line with the sort of movement of the market. We launched into staples this year, which is beyond sweetener with millets, dal and rice. And this portfolio fared well. It was a good start. We did just under 300 crores of revenue. This will continue. I think we are focused on building a strong organization, a strong team.
So how much growth this year in this business? I mean, just a sense, do you touch 1,100 crores of revenue more?
On the non-sweetener side, I think we'll grow another 20 to 25%. On the sweetener front, we will actually focus more on growing the value-added piece. I think we're quite happy with the base business of branded white sugar that we have. And on the non-sweetener front, on the staples front, rather looking at bringing in more products which are margin accretive on the lines of convenient foods, which is your roti mixes, dosa mixes, so on and so forth. So I think we'd focus on that. Of course, our focus is also on distribution. We closed F25 with a little over 2 lakh outlets of coverage. This will move closer to 3, and we will focus on deepening our presence in the quick commerce, e-commerce, as well as the larger modern trade channels.
Thank you very much, Mr. Murugappan, for joining in. That's EID Parry for you. For the markets holding up with a gain of about 0.3%, the Nifty is above 24,800. Let's find out if there are any 10 a.m. trades. Mitesh Thakkar is back with us. Mitesh.
Yeah. So I think, the index has come off, as I said, it's mostly a market which is sideways, just chopping around, and not too much of a directional bias. On the stock side, I have one buy and one sell. Bharat Forge is something which has broken into a fresh swing high. So buy here with the stop just below levels of 1255 for targets of 1300, and Phoenix Limited is on the negative on the sell side. I would suggest a stop just around 1595 for targets of 1530.
Okay. All right, Mitesh, thanks very much. We'll take a very quick break on that note. Come back. Latest commodity market action coming up with Manisha Gupta. Welcome back. So, as promised, let's go to the commodity markets. Equities are holding up fine. Nifty still up about 70 odd points. Commodity markets now. Manisha is in here with us in the studios. Manisha, what's the headline? Mr. Donald Trump is keeping the markets excited.
Oh, absolutely. Since he's taken office, even before that, it's been quite exciting in the commodity markets here. But overnight, with the kind of statements that we've heard from the federal court, trade court, is what really seems to be moving many of these commodities. So, overnight, we saw the crude oil prices gain up by a percentage point. And after the U.S. Court of International Trade has declared tariffs unlawful and has also said, or rather ordered tariffs to be vacated and blocked, we've seen some bit of an ease in business here. And many of the industrial commodities, energy as a space, has seen some buying in the overnight market. There. Well, apart from that, what really seems to be supporting the crude oil prices also is the OPEC plus ministerial meeting that happened yesterday, and they haven't moved the current output quota. So that was supportive as well. Having said that, the OPEC 8 plus are going to be meeting on Sunday, that is 31st of May, and they could be talking about increasing production from the month of July to the tune of 411,000 barrels per day. Remember, they want to increase production and bring it to 2.2 million barrels per day by the month of November. So statements on Sunday perhaps could move the markets on Monday here. Having said that, it also is about U.S. barring Chevron from exporting crude from Venezuela. That is a developing story and can have implications in sense of supplies going forward. Chevron can continue to hold its assets in Venezuela, but it cannot increase assets or export Venezuelan oil. So that's a bit of a tricky situation there. Also, the markets are anticipating that the summer season demand is going to be on the stronger side. That starts from mid of June. The markets also are looking at a heavy Atlantic hurricane season within that part of the world that perhaps will also bring premium to markets. And then the Canadian wildfires have been going on for too long and could be hurting supplies, is what the reports really seem to be suggesting right now. The markets have a keen eye on the US and Iran nuclear conversations as well. We've seen 5 rounds of conversation without much progress there. So what happens on to this one? There's another meeting happening this weekend. Keep your eyes on that one as well. The US inventories also have declined by nearly 4.2 million barrels in the previous week, adding support. So when you look at all of these factors and fundamentals, suddenly it seems to be turning for the positive for the crude oil prices. Other one that I want to add is the Baker Hughes report, which says that the operating oil rigs are now at the lowest since November 2021. So that drill, baby drill, also doesn't seem to be really happening on ground there. What the markets will now watch out for is the first quarter GDP estimates that would come in from US. It also is going to be about the weekly jobless claims that comes in today, and the PCE price index data comes in tomorrow. So it's going to be a loaded next couple of days.
Okay, all right. Manisha, thanks a lot for that. Well, let's focus on a couple of stocks that are moving around. In Wellspun Corp, that's the one that delivered its set of numbers. And let's run you through the top points why the street likes this set of numbers. First up, in terms of an EBITDA, in the quarter it came in at around 460 crores. And we pull up a chart, you'll see it's been steadily improving from around the 350, 400 crores. It's moved to 460. And in fact, that's almost the record high that we've seen. So EBITDA per quarter coming in at 5-quarter high. Next up, the guidance. Very, very impressive out there. Last 2 years, the EBITDA guidance that they lay out, they go ahead and they've achieved more than that. Now, for this year, if you compare the guidance that they're given of around 2,200 crores with what they've achieved last year, they're guiding for an 18% growth in terms of an EBITDA growth, which is fairly good. Keep in mind that they include the other income in the EBITDA calculations as well. They had a small net debt as of the last year. Well, that's turned into net cash. So now cash in the books is close to around 5% of the market cap, though they have a big capex plan for the next few years. The order book as well, very impressive, close to around 19,500 crores. So they've got order visibility for more than the next 1 year or so. And since things are looking up for them, they have announced a greenfield project in the United States. That's for LSAW pipes. They've given us a lot of reasons out there, but they are saying that demand is very, very strong. And remember, for the US business, which was virtually absent for the last year, that gives them better margins. So put everything together, the stock is almost at the highest level we've seen in the last 52 weeks or so. Currently, that it's up close to around 8%. Good set of numbers, good order book, fabulous guidance going ahead.
Okay, that's Wellspun Corp. Stock is fired up in excitement today on the back of those numbers. By the way, as we take our next break, just a quick check on the market. It's cooled off a little bit from that initial pop of almost 120 points. The Nifty has now come down to a gain of just about 70 odd points. The weak hands include the non-banks today. Very interesting. Bajaj Finserv, Bajaj Finance, Jio Finance, Shriram Finance, HDFC Life. So the non-banking financials, they are the ones that are not too excited this morning. And then there are one or two other names like Tata Consumer and BEL. So that's where the slight sense of caution is in the market. But otherwise, I mean, it's not bad at all. Tech and consumer-facing, tech and global-facing names like metals doing really well. So JSW Steel, Infosys, these are the stocks that are retaining a bulk of their gains. And IndusInd Bank, unshaken, unstirred with this whole insider trading issue coming up. Because remember, it is, many of these 5 key management personnel, they've anyway been sort of moved out. They're no longer with the bank. So let's see. Market not too perturbed with the SEBI order that came in yesterday. That's about 1% on IndusInd Bank.
Okay, Som Distilleries, by the way, the numbers were fine, but the stock is now nosedived. It's down close to about 10 to 11%. And on the way up, buying has emerged in names like MMTC and India Pesticides. Good volumes, on these names and big moves on the way up. Well, that brings us, we're going to slip into a break on that note. On the other side is our special segment. It's The Economy. Lata will discuss the state of bond yields and banks in India with Ashish Gupta of Axis and Rikin Shah of IFL.